Right now, global attention is fixed on the Middle East, but within the American financial system, a different kind of systemic instability is taking hold. The United States is quietly standing on the edge of a financial crisis that is being largely ignored. The warning signs are coming from the very people who managed the 2008 crash. Lloyd Blankfein, the former head of Goldman Sachs, recently stated that the market is in the absolute late stages of its cycle. He believes we are due for a reckoning, noting that a lack of discipline has built up money in opaque, illiquid places. Jamie Dimon, the current CEO of JP Chase, is pointing to the same horizon. Following recent bankruptcies in the lending sector, Dimon famously warned that, when you see one cockroach, there are likely many more hiding in the walls. In his view, these early corporate failures are just the first visible signs of a larger, cascading collapse. The data reveals a historic gap between the markets and the people. On top, the total value of all publicly traded U.S. stocks has climbed to over 210% of GDP. This is significantly larger than the peak of the 2000 dot-com bubble or the 2008 crash. Yet beneath this growth, 80% of the U.S. population is living through an effective recession, struggling with stagnant wages and high costs. This imbalance is not a coincidence. We are witnessing the collision of three separate, highly unstable financial bubbles. And as they begin to burst, Wall Street is already preparing a strategy to ensure that average citizens pay for the fallout. The first bubble is found in the $3 trillion private credit market. After 2008, new regulations prevented traditional banks from making the riskiest corporate loans. Instead of disappearing, that activity simply moved into unregulated financial firms. This created a shadow banking industry that operates with almost no public transparency. These funds attracted capital by offering double-digit returns to investors. However, the companies receiving these loans are often the most fragile. As economic conditions tighten, we are seeing the first wave of cockroach bankruptcies that Dimon warned would eventually emerge from the shadows. The strain is already reaching the largest asset managers on Earth. BlackRock and other Wall Street giants have been forced to limit withdrawals, effectively keeping investor money frozen inside the system. This chart shows why the money is stuck. Private credit funds do not keep cash on hand. They lend it out to risky companies. Because these are long-term, complex loans, they are illiquid. They cannot be quickly sold. When investors panic and demand their capital, the fund finds its assets are locked away in loans that no one wants to buy. This triggers a destructive feedback loop. When a major firm like BlackRock puts a cap on withdrawals, it signals that the fund is in trouble. This causes even more investors to demand their money, forcing firms to try and sell off their holdings at a loss just to raise cash. While these private credit firms are unregulated, the traditional banking system is still deeply exposed. U.S. banks have lent nearly $300 billion to these shadow firms. If the private credit market implodes under the weight of these defaults, the losses will move directly into the balance sheets of the major Wall Street banks. The second bubble is what propped up those risky loans in the first place, the tech sector. Many companies taking out private credit loans were software firms, now going out of business as artificial intelligence technology disrupts their business models. This creates a dangerous reliance on the magnificent 7 tech giants, like NVIDIA. Currently, U.S. GDP growth is an illusion sustained by these few companies. In the first half of 2025, over 90% of all economic growth in the U.S. came from investments in AI-related equipment and software. Despite their sky-high valuations, the actual revenue is not keeping pace. OpenAI, for example, has over $1 trillion in financial obligations, yet its actual income is a fraction of that. They are operating on a scale that requires an endless stream of new capital to survive. To maintain the appearance of growth, Silicon Valley has become incestuous. AI companies are lending to each other and investing in each other, creating a circular flow of capital that manufactures the appearance of profitability where it doesn't actually exist. The dominoes are already lined up. If the tech bubble pops, these companies will default on their loans, causing the private credit market to shatter alongside the artificial intelligence industry. Sophisticated investors can see these bubbles colliding. They know the private credit market is on the verge of imploding, and they are desperately seeking a way to sell off these toxic loans before the total value zeroes out. To stay ahead of the next major shift in the global economy, subscribe to Universal Money Orbit. We provide the research on financial power that traditional outlets frequently overlook. In August 2025, the Trump administration provided Wall Street a solution. They issued an executive order titled Democratizing Access to Alternative Assets for 401k Investors. This policy followed intense lobbying from major donors like Stephen Schwarzman, the CEO of Blackstone. As the head of the largest alternative asset manager on Earth, Schwarzman has a direct interest in finding new buyers for high-risk investments. Blackstone's exposure to the private crisis is so severe that its stocks fell by 30% in the first quarter of 2026. The firm needed a way to offload its bad investments, and the White House responded by opening up a new market, the retirement savings of average Americans. By framing this as democratizing finance, the government has legalized a massive transfer of risk. Billionaires are now legally permitted to sell their most toxic, impending losses into the pension funds and 401ks of the working class, ensuring that average people are the ones left holding the bag. While these domestic bubbles are already strained to the breaking point, they are now facing an external shock that could force them to burst: the U.S.-Israeli war on Iran. This conflict in the Persian Gulf is currently triggering the largest oil and energy shock in history. Because this region provides the raw chemicals and energy that power the global economy, the disruption is immediate and severe. We are seeing the consequences move through the supply chain. Fertilizer prices are soaring, which will lead to a dramatic spike in food prices and the return of aggressive, uncontrollable inflation. This is where the domestic and global crises meet. Rising energy costs force the Fed to keep interest rates high, which is the exact environment that causes debt-heavy AI firms and private credit funds to shatter. The war in the Persian Gulf provides the final pressure that pops the bubbles Wall Street has spent years inflating. This convergence suggests a fundamental shift in the global financial order. In our next video, we will interview economist Michael Hudson to discuss how this perfect storm is challenging the long-term dominance of the US dollar. When the systems designed by the financial elite finally fail, the architects rarely take the loss. They simply use their influence to rewrite the rules, ensuring that when the crash arrives, the working class is the one left to pay the bill.